Good morning, everybody. I'm Jeff Burns. I'm the Chief Investment Officer with MERS in Michigan. I'd like to welcome you to the MERS annual conference. By the way, notice I didn't say annual meeting, it's the annual conference. I hope everybody, well, I understand everybody had a good time last night. That's at least what somebody told me. And what I'm going to do today, okay, this works. So I'm going to provide an overview of the fund's performance year to date. I'll highlight a little bit about the past year as well. Talk about the asset allocation. And then I'm going to have a conversation with Simona Makuta from State Street Global Advisors. And we're going to try and put the MERS portfolio in the broader context of what's happening in the global financial markets at this point in the business cycle. And then also we're going to hit a little bit, or at least I will, on future trends in the portfolio. All right, so I want to start with this slide because we're at a historic time in the global financial marketplace, and that is interest rates are at historic lows. And what this slide shows is the rolling 10-year return of MERS portfolio. So at any point in time on that green line would be that's the return you had for the trailing 10 years. And then the red line is the rolling 10-year Treasury bond. And it doesn't go perfect, but what you see is a trend bringing returns lower. And it's a simple case of the fact that equities, where the bulk of your returns come from, are priced off fixed income. And if interest rates are low, it puts yourself in a challenging return environment. Doesn't mean you can't get higher returns, and I'll hit on that. We've been successful recently, but it does put some pressure on reaching your objectives, and it also allows for some creativity to get there. So what this slide shows here, I showed this last year, and this came out of the Wall Street Journal, and I just think it's a perfect slide to kind of explain with a visual where we're at. And if you look at the far left, you'll see 1995. And essentially to get a 7.5% return at a very low risk of 6% standard deviation, 100% bonds would get you there. You go to 2005, now you got to add some international equities, you got to add some real estate, you got to add some private equity, and you kind of double your risk. Now go to 2015, you really have to expand your opportunity set to get to the same level of return with almost triple the risk. And that's really where we're at today, and I think you're going to see those changes reflected in the portfolio in a couple slides. So what this slide shows is the portfolio that we try to build for you. We're long-term investors, we're institutional investors. We're well aware that you're going to have cycles in the market. You're going to have periods where things are doing well, which we've had since 2008, but you're going to have shocks to the system. And we want to make sure that the drawdowns are limited. So what we do is we build a diversified portfolio. The upper right is the blue dot is the S&P 500, higher risk, and the highest returns. But it's volatile. I mean, you can have drawdowns as much as 20% at any given time. You go to the lower left, and you see very low risk. That's the 90-day T-bill. But your returns are simply not going to allow you to meet your liability requirements. The diamond in the middle would be the policy benchmark. So if we didn't create an active portfolio and we just put it in the policy benchmark, that's the return you would get. And you can see MERS is a little bit above that to the left. So we've built and designed a portfolio that provides higher returns than the benchmark at a lower level of risk. So these are the returns that we've had this goes through June 30th. And what you can see there is we've outperformed our policy benchmark for all time periods. And what that means is that the asset allocation selected by your board and the active management provided by the investment staff as well as external managers has added value over an extended period of time. And I would highlight at this point that year to date we're at 9.25. So the return, and last year we had an 11.2% return. So while it's, we're 8 years into the recovery, the returns have been strong, very strong, and we're pretty happy with that. And I would anticipate, well, when we have our talk with our expert economists, we're going to find out what next year holds. So a little bit about the asset classes. I talked about that we have a diversified portfolio. A lot of people say, why don't you put it all in cash? Well, I demonstrated that cash won't get you where you need to go. And the same thing, while equities will, we have to make sure we've got cash on hand to make our pension payments. So we build a diversified portfolio that's going to get us as much of that equity return with reduced risk. So we've got 4 asset classes. So we've got global bonds, global equities. We have real assets, and think about that being real estate, farmland, commodities, and then we have diversifying strategies, which is a newer asset class, which we added in 2013, and really is a fixed income substitute. And what we're trying to do is get really those traditional fixed income returns closer to 7-8% that we got in the past, and with similar downside risk. Okay, this is the slide that I show every year, and this is a slide that, as long as this slide looks like this, I get to keep coming back. And what this shows is, you go back to, if you gave MERS $10,000 in 1975, would you be better off with the actively managed portfolio, if you just keep reinvesting the money, versus the actuarial rate of assumption? And this shows that your returns would be 67.4% higher. So, so I get to come back next year. So a little bit on the asset allocation. We do it every 3 years, and this is a reflection that we, it's enough time, but the market moves so fast now. We think that about every 3 years we want to do an academic study where we reflect really on what's happening. And there we go. And then in 2013, we had an 8% assumption and at 11.74% risk. And then in 2016, the big shift was we reduced our fixed income exposure. We're going to spend a lot of time talking about that, but with low interest rates, that's simply, with the 10-year Treasury, this year it's varied between 1.8 and 2.25. That's not going to allow us to hit our long-term return assumptions. So we lowered that as much as we can. We are a mature plan, so we have pension payments we need to make. So there's a limit to how much fixed income, how much we can reduce it, and that's really about as far as I think we can go. The board last year lowered the return assumption from 7.75. This is something that we monitor on an ongoing basis, and we didn't change it for over 30 years, and we're, it's the kind of thing that doesn't change very quickly, but we look at it every year. And we added, the big changes, we added a little bit more to real assets and to diversifying strategies. So strategically, the big shifts that we made are right here, and that is after 2008, the global financial crisis, we overweighted the portfolio versus a basket of global securities to the U.S. Equities were extremely beat down. The U.S. currency was low, and so we had a really good run that really helped the portfolio. But we're nearing the end of that cycle, so we've been shifting to international securities as well as emerging market securities. And that's helped us out this year, and I think you're going to hear a little bit more about that. So kind of takeaways from where we're at. There's no question that it's a challenging investment environment. You've got elevated geopolitical and market risks. I expect that to continue. And lower interest rates, while in the U.S. they are starting to go up a little bit, I think that they're going to persist at least for the medium term. Some portfolio trends that you'll hear more about in the coming years. Right now we're managing 30% of the assets in-house, and that means that results in savings to you. So it costs less for us to do it ourselves, and historically we've been able to also add additional returns and lower costs. The cost for data, the cost to manage portfolios even externally are coming down. So that's a trend I think you're going to see persisting, and what that means to you is that the cost to manage your portfolio is going to come down over time. So at this point, we're going to shift over to the soft seating, And we're going to have a conversation where we talk about the global economy and try to fit what's going on with the portfolio that we're all invested in here with what's happening more globally. So what I'd like to do is introduce Simona Makuta. She's a senior economist and vice president with Investment Solutions Group at State Street Global Investors. In her role, she monitors macroeconomic and political developments in the G8 economies and key emerging markets. She helps develop the House view on global economic trends, policy, and investment implications. Prior to joining State Street, Simona led the Asia Pacific macroeconomic practice at IHS Global Insight, a global provider of economic, industry, and country risk analytics, where she oversaw the team's Asia-focused analytic work. Simona holds a master's degree in international economics from Suffolk University in Boston and an undergraduate degree in international relations from West University of Timisoara in Romania. I would ask everyone to give a warm welcome to Simona Makuta. Good morning.
Hello. Good morning, everyone. Thank you so much for the warm welcome. I think we also owe Jeb a hand. I think his performance and what he showed in the slides was pretty impressive, so I think he want to say good. So, but looking into the room, I don't know if it's you or me that I see quite a few empty spaces here in the front.
Well, I think I covered.
You think it's me?
No. It was the event was so incredible yesterday.
I see.
That people are a little tired. I think people had some fun last night. That's what I heard.
It makes me feel bad that I missed that boat ride. You know.
I have it on good authority that it was a good time. So
next time.
So I think what I'd like to do is kind of set things up a little bit. But the first thing I would like to do is, I think we try to be transparent. And we had a little fight yesterday, and so I'm gonna pass on the clicker to you.
Yes, as he should.
As he should. There are her slides. So we were prepping yesterday, and I got a little territorial on the clicker, but
yes.
But I was still reeling from the fact that apparently I'm not. You weren't here at lunch, but there was talk that, I wasn't funny and I wasn't a good athlete and I wasn't a good driver. So, it's what.
Didn't sound like a very good day.
Yeah. Well, I reflected on it, and it wasn't. None of it was true. So, and what's interesting actually is I was thinking, my father was also a very good driver. He said so quite often. So
himself.
he did. So
it must be true.
It must be true. Oh. So when we talk, there's really we came up with kind of 4 themes that we're going to talk about, and that are impacting the economy: demographics, labor productivity. We're going to talk a little bit about the recent market improvements, because there are headwinds to what's going on, but the last year or so, that's not even true. The last going on close to a decade, it's been surprisingly strong and resilient. And then we're going to talk about the impact on inflation. And kind of before I turn it over to you, I just want to make a couple statements of things that I see happening in the marketplace, kind of the realities that I'm, I'm functioning under. The guys at PIMCO talked about the new normal back in 2008, and that was what you could simply expect going forward as developed economies have matured is, 2% growth is good. You're not going to see in the U.S. 3-4%. And what I kind of see the secular conditions persisting, I see lower inflation, lower nominal returns. That means absolute returns above inflation. Developed market stress due to demographic and entitlement issues. Market and societal volatility. And I see that continuing over the next decade. To kind of, I don't want to depress everybody, but because I still think the U.S. is in a strong long-term position from a we've got, strong resources, energy independence is where we come to the U.S. Geopolitically, we're positioned quite well. So long term, I'm optimistic, but I just think there are some forces which are going to make for a challenging environment over the coming decade. So that's kind of how I see things unfolding. No.
I would very much agree, and I think that's exactly what we are going to try to cover in this discussion, not just to say that these are the trends, but try to dig a little bit deeper and say, okay, but why? You know, why exactly do we hold this view that, you know, we have a lot of constraints on growth and implicitly on investment returns going forward? And you know, one thing that struck me as I was looking through your slides and knowing what my slides were is that independently, you and I decided to begin our respective presentations in the same place. And that was a chart showing long-term evolution of interest rates. You showed it in a little different way. You were looking at treasuries, but the point is, you know, we both obviously believe this is very important. I would go a step further, and in fact, I would say it's not just important, but it's critical. And I think you clearly showed why it's critical, because interest rates drive in investment returns. You've showed it, you know. This has been the experience. If you ask yourself why, you know, why is this connection there? Think of it as interest rates. What are interest rates? Interest rates truly are the cost of money, right? It's the price of money. In this room, you are all investors. You can say, what do you have to sell as the investor? You have money. You're not selling it per se, but that's what you have. That's the good that you have in the marketplace. If the cost of money goes down, well, you're going to get less, right? You're getting less return. I mean, I think it's very easy if we make think of an example. If you're a corn farmer and the price of corn goes down, we all realize very quickly that that's not good, right? If you're an investor and what you're trying to sell is money, if the price of money, which is interest rates, is going down, it obviously is not the best situation to be in. So I think we need to begin the discussion here and recognize that this is a very meaningful structural constraint, and put it in other words, your job is getting harder every year.
It's an opportunity for personal growth.
Well, one has to be optimistic.
But I think it's interesting too. It's like, I mean, lower interest rates, so, you know, we all refinance our houses. I mean, so the cost of buying a house comes down, the cost of buying cars comes down. So in a weird way, it's good for the consumer. You might even make the case it's deflationary in a way, but it does put stress on everybody's portfolio.
Yeah, yeah. So what I'd like to do next is, you know, so here's the reality of interest rates. Then I think it's helpful to try to understand, okay, what's driving this? You know, we see this downtrend, you know, it's not new. It's been decades in the making. It doesn't seem, based on current data, that it's about to turn around anytime soon. But how can we think about this? What's behind it? So I have this very cheerful chart here that I like very much, but I want to walk you a little bit backwards onto it, because you say interest rates and the nominal interest rates that you've mentioned, they don't happen out of the blue, right? They are the result of what's happening in the economy. And implicitly, you need to think of interest rates as reflecting the opportunity set in the economy. So say I'm an entrepreneur and I come up with a brilliant idea and I think I'm going to make a huge return on my idea. You are the investor, you hold the money, and I need financing. I'm going to come to you, I'm going to say, I want this, you know, I want to finance my project. Obviously, I'm going to pay you less than what I expect to make on my own project, right? Because I need to keep something for myself. If what's happening in the economy, if the type of projects that we come up in the economy are less profitable, then the cost of money will come down, interest rates will come down. And when you think of the profitability of the economy, you're really talking about growth, you know, economic growth. When you hear experts talk about real GDP growth, this is essentially what it is. When we are growing, you know, we sell more, we make more profits, we can, you know, there is a return on capital. And the problem right now, not just in the US, but globally, is that there are a number of very, structural, fundamental factors that are constraining economic growth. And, you can have the, economists like to do all sorts of equations, and there is something called the, the production function. But really what that tells you is that in order to produce anything, you need two things. You need labor, and you need capital. Just imagine, you're on the factory floor. What do you have? You have people and you have machines, right? That's how you produce anything. That's what gives you output. And then how well those two things work together is what economists refer to as productivity. Is Jeb, able to use the same machine and make 3 shirts in 1 hour, whereas Simona is not so great and she only makes 2? Well, he's more productive and I'm not. That's the whole idea. It's, sometimes these concepts sound complicated, but it's pretty much common sense. How well do you utilize what you have in order to produce an output? And this is where the story starts being a little bit depressing. We did mention that we want to talk about demographics, and that's what labor is all about. Think about producing it's a little bit like baking. So my oldest daughter loves to bake, and you learn very quickly that with baking, what matters is the quality of the ingredients, but also the quantity of the ingredients. The more flour and sugar, and the bigger the cake will come out, right? Well, the challenge right now for the world economy is that one of the key ingredients of production, namely labor force, demographics, is actually shrinking, or at least no longer growing as fast as it used to be. So here's the next slide, and that tells that story. I think it's a little bit hard to see from the back of the room, but essentially this shows the rate of growth in what we consider to be working age population. So typically we view people between 15 and 65 as being the working age population. The more of these people are coming into the marketplace and contribute to growth, the easier it will be to achieve higher growth. The problem, as you see, is the top line, that's the world number, and the lower line, the light blue, that's the United States. But they follow a similar pattern where we've peaked in terms of growth in late 80s, 90s. And since then, we are growing slower and slower and slower. And this is not a trend that's likely to stop anytime soon.
So, the world's getting older. The workforce is getting older. And it's not just happening. I mean, everyone's read, I think, things about almost horror stories in Japan.
Yeah.
And Eastern European, or not Europe, the demographics aren't that good. And what I hear you saying is it's also beginning to impact the emerging markets as well.
It's starting to happen most everywhere, not quite everywhere, but so, when you say about demographic problems, so it's a problem on 2 levels. One is the fact that you have fewer people, as we just said, and that matters to growth and implicitly to returns, to interest rates, etc. You also have, so that's more sort of the macroeconomist concern of demographics. There is also your problem with demographics, which has to do with the fact that the people that we do have are older and they live longer. So retirement income has to last longer. So there is, it's a problem in more than one way. And to your point, indeed, it's not just an issue in Japan. In fact, it's really scary to look at the Japanese statistics right now. Between 2010 and 2016, the population of Japan actually declined by more than 1 million people. So that's a pretty good sized city just disappearing. Like there is no need for food, there is no need for housing, there is also no workers, who were available to produce things. And this is like just gonna get worse and worse. And what's important to realize is that this is not just a developed market story. I mean, it's true that as societies grow richer, typically the birth rate declines. We've seen this in history pretty much everywhere. But this next chart really tells you that, what used to be Japan, so Japan is the light blue line, and you see that this is, again, population, total level of population. You see how it's peaked and it's declining. But now China is on the exact same path. So this is a problem that's becoming more widespread. It's no longer just pockets here and there. This is a much broader issue.
And I think the key point is that what you get with a youthful population is you get dynamism. That's I mean, the baby boomers. The best example is in the U.S. I mean, you think about the changes. From a business perspective, a societal and cultural perspective that happened over the last 44 decades, it's amazing, and that's because you had a huge youthful population, and there's a positive impact generally on the economy, and so it kind of supports what I'm thinking is that newer normal. I mean, 2% growth is not. This is what we all forget. That's not bad. I mean, it's just not what it was.
Exactly. Yeah. So I want to talk a little bit more about demographics, because the question is, okay, it's the numbers are important, but it's not just the numbers. And the U.S. in particular has a peculiar challenge right now. You might have heard this being talked about, this idea that the labor force participation rate is declining. Well, what does that mean? I'm showing, I want to spend some time on this chart, because really in the US we have a double challenge. So the population is slowing, but then even the people who typically you would expect to be in the labor force and actively working, an increasing share of them are no longer working. And the scariest statistic really is this turquoise line. So this is participation rate. So basically out of the people in that 15 to 64 age group, what proportion of them are either working or looking for work? That's what it means to be in the labor force. You want to work. So you see very divergent trends here in the US between female and male. And the shocking statistic is that light blue line that references the left side. So in the 60s, about 83% of the male population in the working age group was actually working. Today, that's less than 70%. So you're talking about a huge number of people who potentially could be working, but for reasons that we don't fully understand are actually not working.
And could some of this be that the economy's changed, so manufacturing jobs are simply not jobs that were readily available, say when I came out of high school, you simply can't get.
Absolutely. I mean, and that's I think the interesting dynamic that you see. At the same time as the male labor force participation rate has declined, the female labor force participation over the decades has increased. Now this has many reasons, but you can see this reference is the right-hand side. It used to be about 37%. Now it's about 57%. So this has to do partly with the fact that the economy as a whole is moving away from things like manufacturing, construction. So job occupations that typically are dominated by male, and what's doing good nowadays is education, healthcare, and so on. So like places, pockets of the economy where female employment is more prevalent. So it's not a laziness issue.
We talked about that yesterday.
I mean, there might be some, I'm not going to deny it. But I think the question really is it voluntary or involuntary? And I think the changing nature of the economy, to me, suggests that this is really not so much voluntary as, people are having a hard time adjusting to the changes that are taking place.
So I've got two questions that I'd like you to dig into on this slide. And so talk about the benefits of, female participation in the U.S., increased. So I know the Japanese are trying to do that as well. Talk about how that increased participation helps the economy. And then I think we should spend a little bit of time talking about positive effects of immigration.
Yeah.
And also because there's some really good examples of when you don't have immigration that can be a drag on the economy.
So the one way to say, okay, so we have this situation, population is declining. What do we do? Are we doomed, or is there anything that we can do about it? So there are two things, generally speaking, that you can do about it. One is to say, okay, this is the population that I have domestically. How do I make better use of it? And basically that means, how do I encourage the people that are here to work? Well, one way is, for instance, if you're trying to to encourage female labor force participation, is to make it easier for workers to join the labor force. What are some of the challenges? Cost of daycare. I mean, I have 4 kids. I've been paying essentially college tuitions for years, even though they are like, barely like 12, 14 years old. So it's an extraordinary burden. The entry barrier is very high because you have to make at least enough money to compensate for the, what you're going to spend in childcare. Because that's a very good example. And in fact, that's what Japan is doing very actively at the moment. I have a chart here. To me, it's very. I'm going to skip back and forth a little bit. Just don't mind me. But I want to share this because it tells you what can be accomplished when the right policies are in place. This is just a cross-country comparison between female labor force participation in Japan, United States, and the UK. And you see how US is the light blue line. It used to be sort of the highest level country there, but it's declined a little bit. And Japan used to be the laggard. Very few Japanese women were working. And guess what? Over the decades, that's actually picked up. And you may have heard this term Abenomics. This is Prime Minister Shinzo Abe's package of reviving economic growth and reaccelerating economic growth. A key pillar of that is actually to bring to increase the participation rate of female, and they seem to be succeeding. And a big part of that is actually just making childcare cheaper. So that's a domestic solution to the demographic problem.
And
the other
they have to do that too because they're not real immigrant friendly there.
Well, exactly. So I mean, their solution has been focused on dealing with it domestically. But typically, a country has the option also of encouraging immigration, right? So I don't have, the birth rate domestically is very low. What can I do to bring, essentially you're bringing in bodies, right? Workers to populate those factory floors or, hospitals or so on. So that is another solution. Immigration can be a boost, and in fact, typically immigration is not simply, despite the fact that it causes a lot of social anxiety and fears that, people will be losing jobs, but, all the data tends to suggest actually that immigration contributes positively to growth.
Yeah, I mean, I agree. I mean, I've looked at the data. I mean, the U.S., our birth rate is a little bit higher, and our immigration, both, legal and the immigration we pretend that we try to stop, that we haven't stopped for 20 years. I said that out loud.
So I'm just going back to the order of the presentation, but I think we talked a lot up to this point about this, the demographic problem. So the quantity of labor is diminishing. The other big problem we have on our hands nowadays is that even those workers that we do have, they seem to be less productive than they used to be historically. So it's a double whammy in a sense because, this chart basically shows you the growth in labor productivity. It used to be, in the 70s, pretty high, and it was pretty consistently, around 2.5% for a long period of time. But since the crisis, and this, please make note, this is not just the US, it's the G7 economies, which are quite representative of what's happening globally. The rate of productivity growth has plummeted. And really, nobody quite knows exactly why.
Because wouldn't you would think with technological advances that productivity would be enhanced.
You would think, and granted, whether it's just playing Pokemon, that doesn't do really much to economic growth, but you have to think that there is a lot of technological advances that can, positively and productively be deployed. So let's, so how does productivity happen? It's driven essentially by innovation. Somebody in this room, a very smart person, comes up, wakes up one morning and says, "Oh, I figured out a better way to do this." Right? They are the innovators, and the rest of us then say, "Oh yeah, that's a great idea. I'm going to start doing it that way." So that's the second half of the process, which is called the diffusion of innovation or the spreading of that innovation. So what tends to, there is a lot of debate in the profession as to what's causing this weak productivity growth. Some people are saying, well, demographics actually has something to do with it, because you have a lot of, very experienced older workers retiring from the labor force. The baby boomers are retiring and they are replaced by younger people, less experienced people, perhaps less productive people. This could potentially be, a temporary phenomenon, because eventually those new people get up to speed. But there is another theory, and actually OECD did a major study where they tried to look at productivity not just from a 10,000 feet high level, but go at different companies and see what's happening. And they said, let's group companies in 3 categories. The ones that are like leaders in global innovation, the Apple, the Facebook of the world. Then there are other group of companies that are leaders at the national level, and then companies that are sort of the laggards. And the interesting thing they found is that even in this period of very low productivity growth, the most innovative companies globally, they still innovate at the same rate they ever have done. So that's a hopeful sign, in the sense that, as a whole, we are not getting, we are not losing our edge. We still can come up with new ideas. But the problem they've identified is that, the diffusion, the propagation of that innovation has slowed. And then the question is why? I don't think the debate is settled on it, but my theory is that some of the changes we see today are actually, there's always been creative destruction. Something is being done better and the old way of doing it falls by the wayside.
So, quick example, everybody used to have a BlackBerry.
Yes.
Anybody have a BlackBerry in the room?
I just got rid of mine Monday.
The last remnants of the old day. But, I think there are many examples, but the idea being that, if the new idea is actually like a wholesale change from the old way of doing business. All the existing companies who were producing that product or that good up to now, they are being made obsolete overnight almost.
We were talking yesterday, I think the Amazon example would be a good one.
That's the perfect example. Here, you had the brick and mortar retail industry. It's being utterly decimated by a new way of doing business. And what's the problem? The problem is that, the existing companies, the Macy's of the world, the Walmarts of the world, they can't just overnight get rid of what they were doing and just adopt the new system. So in the process, they have to almost run a dual system, right? That costs a lot of money to still keep the stores running and, pay the electricity and the workers to be there, and then invest in a new platform. So in the process of transitioning to these revolutionary new ideas, you have a very painful process, a very costly process, where you don't necessarily sell or produce more, but it costs you a lot more to produce, and that shows up in weak productivity. And I think the examples are numerous. Just think of Tesla versus the traditional combustion engine. These are true revolutions that are happening.
So everybody has to switch to the new way of doing business, but they've got dual expenses. They've got to run 2 businesses at the same time, one that's failing.
Exactly.
And,
exactly. So I think this is, it's a, perhaps it doesn't explain the entire productivity shortfall, but it's a very intriguing theory that you are in this complete major period of upheaval. The silver lining in this theory is that eventually this transition is complete. And when the transition is complete, you're going to be left with the better system in place. So perhaps, a few years down the line, productivity could pick up again. But it's a lengthy transition, and we are kind of in the middle of it still.
To bring it, to what we do at MERS, managing the portfolio. So we're not retail looks bad in people's portfolios. And I actually had, very recently, I had somebody in my office, and they had a real estate fund, and they were like on their 5th fund, and it was all focused on U.S. malls. Mm-hmm. And they were telling me how great it was. But I have, I read smart. So I was thinking it wasn't so great,
Yeah. No, it really is, it's an amazing period to witness. So, I think we depressed the audience quite a bit up to now. What do you think? Shall we try to find something good to talk about? I think it's about
throw
that.
the flag up right now,
No, but actually there is something good to talk about, and that's the cyclical upturn that you've alluded to. Over the past year, the incoming data in terms of growth, in terms of global trade, industrial production has improved considerably. What I'm showing you here is something that we economists look very closely at. It's called the Purchasing Manufacturer Indices. And we like this very much. This is basically a survey. They go to a huge number of companies and they say, well, are you producing more this month than you were producing last month? Are your orders looking better or are they looking worse? Are you employing more people? Do you plan to employ more people? So, based on what's the distribution of those responses, these indices are created. And as long as the index is above 50, it indicates growth. And the higher the number, the higher the index, the better. And you can see very clearly how, around the middle of last year, we sort of hit bottom in the cycle. That was when, you were coming out of the energy price shock, the mining sector, recession, manufacturing had been hit. And since then, we've improved considerably. So this is, in a sense, you see, these numbers are the best they've been in a few years now. And similarly, when you look at the broadest measures of global growth, we expect this year to be the first acceleration since 2014, and one of the best years since the crisis period.
I want to ask you a question because I'm actually curious. So we talk in my office a lot about, so we've had slower growth, particularly in the recession coming out 2008 was so extended before we really got back to where we were at. So one of my things is I think recessions generally have gotten shallower and shorter. What I wonder is, because you figure after 8+ years we're due for a recession, and what I wonder is, now 2015 we had a slightly negative year. So was that slowdown possibly a recessionary period? When you go down, instead of technically being negative, you just don't grow for a couple years. Mm-hmm. And could we then be, so could this reacceleration continue for, 2, 3, 4 years?
So what we had in 2015 was more of an earnings recession. So, there are surveys of CFOs and, a lot of CFOs were expecting that the economy will go in recession. What did contract were company earnings. On the macro side, in terms of the broad economic growth, we did not have a recession. It's rare that you can have one without the other. They typically go hand in hand. But the reason this happened was that the sectors that were affected were very severely affected, and that was mining, energy. Earnings there really plummeted in line with the oil prices and commodity prices, but the rest of the economy did a lot better. So, automotive sales were doing very well, for instance, during the same period. So this was not as broad of a decline as to generate what, officially would be deemed a recession, but it was a meaningful, slowdown. In terms of can this, improved situation continue? I think it can, and I think what's interesting and worthwhile mentioning is the fact that the improvement we've seen over the past year, in fact, has been more pronounced outside of the US than in the US. Now, partly this is simply a reflection of the fact that the US recovery had been continuous basically since we came out of the global crisis, right? We didn't have a double dip. But particularly Europe was the big surprise, positive surprise this year. And this chart is my way of, trying to tell that relative story. It's a bit complicated, but what I'm trying to get at is to show, what's happening to labor markets in Europe versus the Eurozone. So in the US, people started coming out of unemployment in 2010, and the number of unemployed, which is that light blue line, kept declining continuously ever since. In the Eurozone, by contrast, there was very little progress, in 2011, and then we had the Greek crisis, right? So there was like, the second big shock in a row. So truly the Eurozone recovery did not meaningfully begin until 2014. But at the moment, and over the past year especially, you now have more people coming out of unemployment in the Eurozone than in the US. And population-wise, you can say they are roughly equivalent. They're not exactly equivalent, but similar sizes. So it's a relevant comparison. Why does this matter? It matters because once somebody is out of unemployment and they have a job and a steady source of income, in turn they become a source of demand, right? They will want to buy, maybe a car, or they will want to buy a house. And what does that do? That encourages investment and higher production by other parts of the economy. So it becomes a bit of a virtuous cycle that's starting to take shape in Eurozone. So that's why I'm actually quite confident that this has a good chance of continuing.
So it's a good thing we put some money in Europe.
I think it's a good thing, yes.
Okay, all right.
I knew you deserve some applause. I'm sure, we talked about this yesterday a little bit in the prep, but I think we have to be cognizant that a short-term cyclical recovery is not the same as saying all of the Eurozone issues are put to rest. Right. And certainly I would say in the current shape, with the current institutional structure, it's very hard to imagine that the euro stays, that the euro remain,
we could debate this for an hour. I tend to think the euro's I'm on record. I think eventually it will go away, but it could go for 20 more years.
I think you have a very good point, and those who tend to take that point of view will highlight this next chart. The idea being that, okay, you basically brought a bunch of countries together, gave them the same currency, but these countries are very different in their structure and how competitive they are globally. So this is just showing you the GDP deflator in Italy versus Germany. The way I want you to think about is, if I were to buy an apple, in 1999, it cost the same to buy it from Italy as to Germany. So I'm the third party, I want to buy the apple. It doesn't matter to me, I can buy it as easily from Italy or Germany. The problem is that the cost of production in Italy keeps going up because they're not very productive, much faster than the cost of production in Germany. So now in 2017, if I want to go and buy the same apple, it's costing me a lot more to buy it from Italy than to buy it from Germany. So what would anyone do? We are not going to buy from Italy, we are going to go and buy it from Germany. What does that mean? It's almost like Germany is doomed to boom because they're so competitive. Their industrial base flourishes. They are actually in the midst of an economic boom. Unemployment is, multi-decade low. Italy, in the meantime, is struggling. So this is the challenge. This is like the inherent structural problem because there is no adjustment mechanism. Before, Italy used to just devalue its currency every few years, and suddenly, it's as cheap to buy the apple from them as well. That's no longer possible. So this needs to be addressed. I would say that while I'm very cognizant of this issue, I'm a little more optimistic about the future of the Eurozone and the Euro now than probably I was ever in the last decade. And that simply reflects electoral outcomes in France and likely in Germany this weekend. So I think there is a recognition in Europe that they need to make some changes. They need to have a fiscal transfer mechanism, things that will make this single currency sustainable. And I also don't think it's fair to say the euro is the cause of all evil because
and when you say fiscal transfer mechanism, really similar to the US in that there would be support directly going to Italy, if you will.
Exactly, and that's what President Macron actually is suggested, that they create a European, Eurozone-wide finance ministry with the budget so that, this happens normally in a nation state. Not every state is doing equally well all the time. So when, a state is doing well, there is tax revenues are high in state A and they are transferred to state B to kind of stabilize the situation. You need something like that in Europe, and that's what Macron is putting forward, and it seems as though Germany is more open now to the idea. So it still remains to be seen whether they can agree, but that's why I'm a little more optimistic as to perhaps it can be done.
In medium term, I agree with you. I mean, I think the elites and the government officials are going to do everything they can to keep the euro in place for the foreseeable future. I just worry, it's going to be I think it'll be some kind of stress, probably on the geopolitical side that might break it up, but that could be,
Yeah, I mean, it really is an open question.
Yeah.
We'll have to wait and see. Just one quick point I do want to make. It's also not fair to blame euro for everything, and that's the next slide makes this point. Essentially, look at Spain and look at Italy. This is real GDP in Spain. That's the light blue line, the higher, the one that's higher. And look at Italy, and it's really depressing, to realize that in effect, the Italian economy is almost the same size today as it was in 1999. I mean, not quite, but not much bigger. So no progress over the span of, so many years. Spain, on the other hand, is about 35% larger as an economy today than it was in 1999. So then, clearly, they still have the same euro constraint to growth. What are they doing that allows them to fare better? And the reality is that it's not enough to have this, Eurozone level policies and reforms. You also need to get your own house in order. And you need to reform the labor markets, you need to make the economy efficient. That's what Italy has not done and Spain has done, and you see it in the results.
I think we've got 10 minutes left, so I'd like to maybe kind of shift over and kind of I think we want to talk about inflation, because I think that's critical.
Yep.
And leave maybe a couple minutes for some questions.
Yeah, so I'm, if productivity and the slow growth of productivity is one of the big puzzles in economics today, the other big puzzle is inflation. And what do I mean by that? Inflation has been below what central banks would like it to be for a long period of time. In fact, we are at the point where it's rarer to hit the target than to miss it. And the strange thing is that typically, this is a fairly easy to understand concept in the sense that, why do prices, what are the forces that cause prices to go up? The strange thing is, so Chairwoman Yellen spoke earlier this week, and she talked about this, shortfall in inflation. She called it a mystery. It's very strange and disconcerting to hear policymakers basically admit that they don't quite know why it's low. And typically you would say, okay, it's oil prices are bringing down, gasoline prices and the cost of transportation, and it seeps into other things. Or it can be an exchange rate movement. If the dollar is strong, the cost of imports is declining, and that's dragging down inflation. But over the last year, they are at a loss to explain as to why is inflation low. And I think here too, we need to look at what some unusual effects from technology. And an interesting example is earlier this year, Verizon, for instance, decided to go to a unlimited data plan. So one company decides to do a pricing adjustment on their product. And guess what? You saw it immediately in the macroeconomic data, in the sense that the wireless component of inflation plummeted to the lowest since the 1990, late 90s. And that dragged down the communication component, and it dragged down the whole of CPI. So, this is, I think, the interesting question to ask. Is this, typically we worry about inflation being too low because it suggests there is not enough people willing to buy stuff. Demand is weak. But if this is what's happening, this is not a demand problem, this is a technological effect problem. So how do you deal with it? Maybe we are, again, even here, the same way with demography, maybe we are stuck in this period where the pressures are, downward on inflation from technology.
And lower inflation keeps rates low.
Exactly.
So,
And it's just it's hard to envision that. I think that's the bottom line. It's hard to envision what takes us out of this environment in the next few years.
and just one kind of last point to hit. So inflation, you know, if you're at at the policy level, you know, if you get high inflation, your entitlement problem goes away, your liability goes away. I mean, on the books. Now, if you're receiving an entitlement, then it's worth less. But what I always wonder is, but if inflation goes up, you know, right, then the cost of servicing your national debt, whichever country you are, goes up as well. So what's, you know, I don't believe in conspiracies, but, you know, what do you think the odds are that we're going to be able to, you know, get some inflation in the system?
I mean, frankly, the reason every economist, including Chairwoman Yellen, is scratching her head is because everything we know about theory of economics suggests we should have higher inflation. Why? Because the labor market is doing very well, you know, unemployment is very, very low, and the theory goes that as, you know, there is less spare capacity, you know, as fewer workers to bring into the labor force because companies want to hire, they'll be willing to pay those workers more. And once you pay the workers more, there's more income to go around for them to spend on things, so the price of things should go up. So theory tells us that we should see higher inflation, but we are not. So that's why I think we need to revisit the theory a little bit, and at the very least to be humble and, you know, not have blind faith that this will happen. You have to like start making contingency plans as to what if it doesn't happen? What if you are in this situation for a longer period of time?
Yeah, taking it back to, you know, the portfolio, that's why we've expanded into real assets. You know, that's why we look at diversifying strategies. And, you know, I think inflation will at some point manifest itself. So, but we've taken a more, you know, at MERS, we've taken a more concentrated approach to it. So we've got some pockets which should help us if inflation does happen, but aren't going to hurt that bad if it takes longer to manifest itself in the portfolio. Well, we've got 5 minutes left, so I think it might be a good time to you know, open it to questions if anybody has any.
And look, I'll give you back the clicker.
The clicker. See a question over there?
Well, high inflation is a problem. Inflation that's low, it's a problem when it becomes too low. And it's true that the 2% target that most central banks have adopted, it's a little bit of an arbitrary target. But it's nice to, you know, having a little bit of leeway on pricing allows for an adjustment in real terms in a downturn. And it also, you know, essentially think about this way. If I'm the consumer and I expect prices to go down in the future, basically deflation, what is my incentive to buy anything today? You know, I'm not going to buy that car today. I'm going to delay it. I'm going to expect, you know, wait until the price goes even lower. Well, if you do that, and if every consumer in this room does that, what does that result in? Well, suddenly demand is weak. You know, the producer of that car sees that there's nothing happening. You know, the inventory is not moving. They are going to invest less. And you create a vicious cycle where, you know, there is less demand, less production. You know, if I cannot sell the car, you know, I don't need to hire more people. If I don't hire more people, you know, there is less income to go around via wages. And then it becomes not just you know, the expectation that prices will fall. It's the added problem that now I have actually less income to buy the car, even if I wanted to buy it. So you want a little bit of inflation, just enough to incentivize people to make purchases now as opposed to delaying them.
So there's like a band where it,
yeah,
it works.
You don't want it too high, you don't want it too low. So you want to, you know, like that Goldilocks situation where it's just enough to create an incentive for both buyers and sellers.
All right.
We're talking about inflation is low, and so therefore wages are staying low. But for many years, productivity was increasing at a great rate in the United States, but wages were actually minimally going up or staying static. Do you think because wages were depressed during this time of growth, that's why now productivity is going down, and with the low wages still really there, inflation is staying low as well?
I mean, the reality is that this productivity conundrum is such a complex problem that it's not just one thing that plays into it. If wage growth may not have been as strong as, say, corporate profit growth, but it actually was in the past stronger than it is today. So you have an issue where wages are lower today than they were in the past. In addition, I think there is something else happening in the labor market, because even though you have a lot of, the last 2 months, we have more than 6 million job openings in the US. And yet, and those are records. We've never been above the 6 million mark. And at the same time, you look at the number of people who are quitting their jobs, and it seems too low. I always was struck especially when I first came to the United States about 20 years ago, by how flexible the labor market was in this country. I mean, people truly were moving across country to get a better job. This is in most of Europe, this is a foreign concept, like this idea that you'd pick up and move. But it really gives the economy a lot of dynamism, right? Because what you're talking about is you match the demand with the resources. You improve that, matchmaking process. Well, that matchmaking process and that flexibility seems to have diminished since the crisis. And I personally call it a little bit of a fear factor that has permeated the psyche of the entire population, that despite the fact that there is an abundance of jobs, people don't leave. Well, it's not a good thing to be in the same place for years and years and years where there's nothing new for you to learn. Perhaps you'd be better off and you're contributing more elsewhere and you could get that job, the wage gain. So I think what's happening at the more subtle level within the labor market has something to do with it. I mean, if you're not going to, we know for a fact, and the data shows it, that it's people who change jobs that get higher wage gains. I mean, that's a fact. But if you're not moving, then you're diminishing that possibility. So that's just one explanation. I think there are many things that creates a little bit of a downward pressure.
I think the last thing is similarly to the Great Depression. I mean, the Great Recession did have a psychological impact on the culture and the economy. I mean, I see it in the work I do. People, last conference I was at, people are like, when are we going to stop talking about it? I'm like, I don't think we're ever going to stop talking about it. So we're out of time. I'm getting the look. But thank you so much. This has been wonderful, and if everybody just thank you for your time.